Welcome back to Fast Market here on the Schwab Network. Let's bring in our next guest for our cash tag segment. That's going to be Landon Swan. He's a co-founder at Lightfolio. Welcome back to the show, Landon.
Thank you, Tom. Good to be here. Hey, Kevin.
All right, so we're talking fast food. McDonald's had that news last week, Landon, where they're going to see a material impact maybe from some of the disruptions and conflicts over in the Middle East. But it doesn't seem like the stock, really cares that much. Initially, we fell on that. Are you seeing the data to kind of support this where, hey, even if they see a slowdown in one segment, because of their scale, they'll be able to offset that because everybody's still going to McDonald's?
Yeah, I mean, this is a monster company, right? They've got 42,000 locations, and they're trying to scale that up to 50,000 over the next 3 or 4 years. So, they're an absolute beast. Everybody knows this name. It might be one of the most popular brands in the world. So when we look at the data, mentions and web visits and all that, it's pretty flat. I mean, it's consistent. It's not going up. It's not going down. I think it's maybe plus 3% on a year-over-year basis. I will say, though, since you got this stock chart up, I'm not a huge technical analysis guy, but my goodness, if you can't see the triple top here at 300, you're blind. They've got a lot of resistance here at 300, and I think we're at 292 right now. So that's going to be a tough one. I think that makes investing in this a little bit difficult just because you're just a couple percentage points underneath that very high resistance level. And again, this is the mentions that I was talking about. Pretty flat, steady. And you're not going to see a whole lot of variance out of a company this large unless there's a big problem or they come out with some new amazing sandwich that, just blows everybody away. I will say that, when it comes to mind share, people thinking about fast food, they occupy over half of the world's mind share, right? So they're just almost 52%. And now, little note here, they're down about 2 points from a couple of months ago. So some of these others are growing just a little bit, but still, when you compare it to most of the fast food companies that we cover, you can see McDonald's is definitely the one that takes the brunt of it here. It takes the big focus. And actually, some of the competition, McDonald's even noted that they're feeling pressure from increased competition on breakfast. Their competition is doing really well on breakfast. So when it comes to McDonald's, one thing that concerns me, they mentioned this, and you always hope that they can attract the low income and basically everyone, and that there's no floor as far as who can shop or who can buy from McDonald's. But they actually talked about this in their last call, that the lower income consumer is down on a year-over-year basis. Their prices are up about 10% on a year-over-year basis. So that's obviously putting some pressure on people. And if you're not going to McDonald's, maybe you're just having something at home, or maybe you're skipping, or maybe you're just buying a little bit less when you go there. You're not getting the McFlurry every time you go. I think that's a bit of a concern. And, everybody's feeling that pressure, but historically McDonald's has always been a very cheap, easy, fast solution. They're still easy, they're still fast, but they're not nearly as cheap as they used to be. So I think that's putting a little bit of pressure on them. I do like them moving forward long term. It's just a great company to be invested in. Here, I don't know. I have a little hesitation, again, just because of where the valuation is and how much trouble they've had getting through that 300 level. So I'm more likely a buyer at 305 than I am at 292, if that makes sense to anybody. But I want to see them get through that before I put my money down. But overall, very solid company.
Landon, you made a really good point that I was looking at, as well as when you think of McDonald's, you don't think about growth. But by 2027, they want to grow 25% from 40,000 to 50,000 franchises. And when you think about their price point, the initial reaction is, well, they must be low margins. Well, the franchisees might be low margins, but not McDonald's, not the corporation. They're high margin business because of the way that they own the real estate and lease it out and the way that they do business. The question is, when you have 40,000 problems all over the world, and you have problems in Ukraine right now and problems in Israel right now, and they waded into a little bit, they didn't handle it perfectly with the geopolitics of that situation. But isn't that really just an opportunity to buy this stock a little lower than off its highs? And you're right, 300 seems like a problematic level, but valuation-wise, PE of 25, that's pandemic levels. It's been higher than 30. It's down around 25 now. For me, that probably signals an area where you can at least look at it.
Yeah, I agree. PE is not very low, but it's very, very reasonable, especially if you say we want to grow locations by that high of a percentage from 42 to 50. I mean, that's very significant. Yeah, you don't think of McDonald's as a growth company. You think of it as just a cash cow, spits out its dividend and just does its thing. But obviously, they have a lot more locations to build on. And I think that, there is some concern from investors that the growth, most of that growth is coming internationally, and they're concerned that the Middle East conflict is going to slow that down, of course. But you're right, that's not going to last forever. They're going to get their locations in. They're going to grow from 42,000 to at least 48 over the next few years. Maybe they don't hit their goal of 50, but they're still going to have a lot more stores. And a 25 PE ratio, if you increase your stores by 10, 15, 20, 25%, well, good things are going to happen. So, yeah, I agree. Again, from a technical standpoint, I'm a buyer at 305, and I'll wait till it gets there. But this little pullback is definitely inviting, I think, to investors. The other thing that I would like to mention is, they're doing a really good job of leveraging technology. Their service time over the last quarter dropped 9 seconds on a year-over-year basis. They're implementing a lot more technology. They're basically seeing the minimum wage increases and going with automation. Of course, that's always going to happen, but the consumer is going to win in that regard. And so they're getting better product at a faster price, and it costs the company less. And then it's just up to McDonald's whether they take that in or they pass that savings along to the customer. But either way, it's a win for investors. Their customers are happy at about 63%, which is the same as Yum Brands. It's not a great score, not a bad score, but it's on the higher end of what you would think fast food. So they're doing well there. Again, overall, love this company long term. The price has me just a little hesitant, but if this dips too much more, then yeah, it becomes a lot more attractive.
Yeah, it's a stable company due to the scale, right, that they can kind of offset maybe some costs. But you mentioned pricing. This is Chipotle keeps raising their prices every year, every 6 months, and the consumer absorbs it a little bit. McDonald's is a little different tier here because it's typically cheaper, but I've heard some rumblings from people that would normally order. They don't have a dollar menu anymore, that like a sandwich and fries and a drink used to be like $7-8. Now it's like 12, 13, 14, 15 bucks. I mean, Landon, at some point that, that lower income or to middle income user of this service, that might become a problem, right? Especially if these inflationary pressures keep up.
It is. And the thing that's going to happen if these prices continue to rise, you're forcing the consumer into one of two choices. Either don't go there as much or order less, or your price is now closer to what would be a higher tier product like a Chipotle. And you say, you know what? If we're going to spend this much on lunch, let's just go to Chipotle and spend $5, $10 more for the family, whatever it is. So you got to be very careful. I think that's one of the problems when you're the cheapest solution out there for whatever the industry is, whatever the product is. Your customers are very, very price sensitive. So a company more like Starbucks, Chipotle, they have that insulation where they know that they've got some elasticity in their demand, but McDonald's is a lot tighter. So they've got to watch that. They did mention that on their last call. Prices, again, they're up 10% on a year-over-year basis. They said that the lower incomes are already starting to pull back a little bit. I know it's on their radar. I know that obviously they're gonna try to come up with a solution for this, but that is a big concern for investors. You don't want that price to get too close to the next tier up.
Yeah, robust jobs at this point. Wages going up, so kind of offsetting maybe some of those concerns. But their loyalty program, they're expected to grow to 250 million people, 45 billion in system-wide sales.
And if you notice, for the people who watch this show, if you put your eyes up to the McDonald's around your home, your area, chances are they've upgraded it in the last 2 years.
Right.
They just upgraded the one near my house again.
Yeah.
They did it like 3 years ago. They just did it again.
Yeah.
More automation is all over these places.
Those
now.
franchises are $2 to $3 million a piece for a reason, because those places make money. All right, great stuff, great data as always, Landon. Appreciate it.
Thanks, guys. Take care.
All right, that's Landon Swan, co-founder at Likefolio, breaking it down for us. Kevin,